I hope you have your financial calculator with you, as I want you to first clear it. So press CFI second function carrying amount. Please always make sure your financial calculator is cleared. Then we have this information. So this will be our cash outflow, and then we had our cash inflows. So to enter our cash flow data, I will press this button to make sure it's showing a negative on your financial calculator. Then you press 12,000 in and data, and there you have your first cash flow. Then 3,000 data. You can put in 5,000 data, 5,000 data, 5,000 data 3 times, or you can say 5,000 and this button and 3, and then it will use 5,000 for 3 years. 4,000 data for our last one. And then if you want to calculate your IRR, your interest rate, you will press second function rate comp. Or if you want to calculate your net present value, you'll press second function down arrow comp, and you will get your answer of 10,000. So please make sure you understand your financial calculator and you're able to calculate the value in use. On this slide, I just want to highlight a few important things. Depreciation will not be included in my cash flows as it is not a cash flow. My interest charges and tax payments are also never included. Restructuring is a funny one, so therefore, please take note. You will exclude cost of future restructuring if irrespective of whether the entity is committed to the restructuring or not. I'm always going to exclude the cost. I will, however, include the cost saving or other benefits due to the restructuring, but only if the entity is committed to the restructuring. If we look at future improvement to an asset's performance, this is also a funny one. I will exclude future finance charges, tax, and capital expenditure incurred to improve the asset's performance if it is not yet incurred. So I cannot include it in my future cash flows because I haven't incurred it. However, I will include the cash flows if the improvement costs were actually incurred, or the improvement costs form part of a restructuring and the entity is committed to the restructuring. So please make sure that you understand and work through your gripping gap with regards to restructuring and future improvements. If we look at a gripping gap example, they've given us management most recent approved budgets for 3 years, and they ask us to calculate the net cash flows to be used in the value in use calc for the machine. So here we will look at our cash in and outflows to make sure which ones can we include and which ones not. So the maintenance cost will be a cost that I have to incur to be able to use the asset. So this I will definitely include. Operational costs, also cost, even though it's indirect cost, I will have to incur this to be able to use the asset. So therefore I will include these costs. Interest, I will never include as it is a financing cost. Income tax payments, tax is always excluded. Then our cost of upgrading the machine, so that will be seen as a improvement. However, they did not tell us whether it's part of the restructuring and we are committed, so we are going to exclude this. Depreciation, not a cash flow. Expenses to be paid in respect of the accruals, it's not a future expense, as it was already recognized in 2004. I'm not going to include this. Basic inflows on the machine due to OC Note 1. So only 40% will relate to the machine. So 40% of these 3 amounts will I include in my cash flows. Then extra profits resulting from the upgrade, not going to take that into consideration. Then I'm going to get the net cash in or outflow from these 3 amounts. Remember this one multiplied by 40%. They've said that The machine is expected to last for 5 years, assuming a 5-year projection is considered to be appropriate. So then it is important to remember that we will have our most recent approved budget. We have this for 3 years, but for the year 2008 and 9, we will then have to include a growth rate. So they say the current year growth rate of 15%, can you see it was an unusual growth rate? It seems unusual given the company's average growth rate was only 8% over the last 7 years. The industry average of 10% is also greater than the business average of 8%. So we are going to be prudent. So therefore, we will only use 8% when we then increase our net cash inflow from 2007 to get 2008 and 2009. If you have any questions, please feel free to come and ask. Thank you.